Is it time to rethink insurance? By protecting lives, livelihoods and assets, insurers contribute between 5 and 5.5 trillion US dollars per annum to global financial resilience, the largest financial contribution to resilience globally outside of governments. Yet today's economies and societies are facing a myriad of unprecedented transformations and uncertainties, such as increasing geopolitical tensions, financial constraints, a spiraling climate crisis, and with profound implications for availability, affordability, and access to insurance, particularly for the most vulnerable. How can we ensure that insurance continues to be a cornerstone of resilience and development? The Insurance Development Forum and our members and partners are committed to collective action. We are rethinking insurance by investing in prevention to reduce risk, by deepening financial protection, and by provoking action. Together, we can ensure that insurance continues to be a cornerstone of resilience, stability, and development for people, planet, for all. Time to rethink insurance, because insurance matters for us all. IDF Summit 2024. Prevent, protect, provoke. Join the partnership, lead the solution.
Yesterday, we kick-started the summit with our opening ceremony, and where we had 3 incredible leaders join us to unpack the theme for this summit. And the theme being why insurance matters: prevent, protect, provoke. I believe that many of you left here yesterday with a lot to reflect on, and clearly the conversation continues into today. So that's, I think, a very positive sign. This morning, we want to kickstart without rehashing the entire opening from yesterday, but to give an opportunity for a reflection on some of the comments that were made yesterday and just on the theme of the summit. And to lead us through that reflection and also an opportunity to frame the rest of the day, I want to invite Honorable Minister Sarvar Qurboniyon, who is the Deputy Minister in the Ministry of Finance from Tajikistan. Welcome, Minister. And Menzinger, who is the Managing Director, Public Sector Business at Swiss Re, and also Deputy Chair of the IDF Operating Committee. So welcome, Ivo, to lead us in this opening conversation on your reflections from day one, but also a framing for the day ahead. Thank you.
Thank you so much, Equitable, for the opportunity to open this year's iteration of the IDF Summit. I don't know how you feel, but I'm always extremely captivated by the comments from Prime Minister Michel from Barbados. It was not the first time that I heard her speak, but the sense of urgency that she is capable of conveying continues to impress me. She made reference to the season of superlatives because we had 12 consecutive months of temperature records over the past year. So I decided I want to structure and lean on her remarks for my opening thoughts. And I wanted to convey 3 things in particular. Uninsurable is uninvestable. I think she conveyed a stark reminder of the gearbox function that the insurance industry actually plays for the economy. There is no financial system that functions without insurance. And that influence comes with responsibility. I'll come back to that a bit later. But ultimately, I want us to understand that we're not just talking about an abstract notion of a growing protection gap. We're actually ultimately talking about a fundamental challenge to the functioning of the financial system and the economy. And those of you from the insurance industry know that this is not just conceptual. If you take a look at certain jurisdictions, Florida, California, etc., we are facing a situation where insurance companies need to withdraw their offerings because they are, rightfully so, rational economic actors. And this is also, I think, an important reminder for policymakers as well as regulators that mandating insurance at non-risk adequate prices is not a solution to the problem. It will actually accelerate the problem. What also became apparent to me yesterday was how interconnected reform of the financial system in the face of the emerging markets debt crisis and climate change actually are. She mentioned, and I quote her, climate and development cannot be separated, and mitigation and adaptation cannot be either. So the reform in the context of Bridgetown 3.0 and the call for expanding the available financial instruments where insurance can play a role to cope with the impacts of the climate crisis, such as the pause clauses on sovereign debt issuance or insurance rider on development loans, are instruments that we need to explore further and where we can play an important role. Now, I was taught that with influence comes responsibility. I mentioned that already, and I would stipulate that we as an industry do have a responsibility. Maybe, as Michel suggested yesterday, widespread uninsurability will indeed be a sort of a wake-up call for society and for economies to act more rigorously, both in terms of climate mitigation and climate adaptation. But I can assure you that none of the companies engaged in the Insurance Development Forum will be twiddling their thumbs and wait until that happens, but contribute in terms of risk assessment, in terms of innovating financial instruments, and building public-private partnerships to at least expand insurability rather than observe and wait until parts of the planet become uninsurable. And in case anyone has been wondering, none of the colleagues that I've worked with for the past 26 years in the industry has ever suggested that risk financing is the holy grail. I think we are aware that insurance can contribute, but is not the solution to everything. Which is a great segue to my third point. The one thing that I believe is underexplored from an insurance industry perspective in the face of uninsurability is risk reduction and prevention. This is, of course, a task for all stakeholders, for a policyholder or a homeowner to reduce risk and its property. It's a task of the insurance companies to help with risk engineering knowledge or products such as Build Back Better to insulate properties against impacts, for instance, of flooding. And I want to use the opportunity to remind us of some comparisons that Rowan Douglas, I'm sure he sits somewhere here, made about 10 years ago when we established the Insurance Development Forum for the first time. He compared climate change with the challenge that in the 19th century urban fires actually posed to the viability of the economy. At that time, houses were built of wood and burnt easily. And urban conflagration actually became a real issue for the economy. In fact, one of these events led to the establishment of Swiss Re in 1863. So at that time, because the pressure and the risk of uninsurability became so large, authorities and insurance companies came together, developed modern building codes to prevent fires from spreading. They agreed on establishing fire brigades every 300 meters, etc., etc. So a collective effort that actually helped tremendously to mitigate the risk of urban fires. And today, potentially climate change is what urban fires were back then. So there is a precedent for concerted action to improve insurability and risk reduction. Before I become too pathetic, let me articulate a few expectations for today. That's the other task I have. And I want to remind everyone, we have a unique setting here. For the first time in the IDF Summit, I'm not talking about here this wonderful room. I'm talking about the fact that we have 30 representatives from governments from across the globe, thanks to the World Bank, which helped to embed this IDF Summit in one of their programs. So we have a unique opportunity to actually share experiences and learn from each other's. Now, most of the topics that the Prime Minister yesterday addressed are on the table today. So I want to remind you that IDF is an action platform, not a talking platform. And therefore, here's my challenge for each and every session, for each and every moderator, for each and every speaker. Please save everyone's time by dwelling too long on the problem statement. I think we all know what the problem statement is. If you do, there is a high risk of you talking to the converted. So also don't leave it at one should, we should, somebody should. Focus on what you and your organization can do and will do. And in that spirit, I want to send, and I conclude with that, in that spirit, I want to send a message to Prime Minister Mia Mottley, who challenged us yesterday to come together and to discuss at a table jointly with regulators, politicians or policymakers, and the industry. And she offered to convene such a get-together. She called it a colloquium. The only thing I would ask her is, this term to me is too scholarly, too academic. It should be a summit of action. Thank you very much.
Thank you. First of all, I apologize for my English. I tried to use my English skills and have a speech. Good morning, dear colleagues, dear partners. On behalf of the government of the Republic of Tajikistan and the Ministry of Finance, let me express my gratitude for the invitation, and it's an honor and a pleasure for me to participate in this high-level forum on insurance development. The forum offers an excellent platform for networking and exchange of knowledge on best practice in the field of insurance and disaster risk finance. As you may know, global and natural disasters and unusual weather activity have become more frequent, especially in the last few decades. This growing environmental and climate risk a serious threat to lives and livelihoods in climate-affected areas, including in Tajikistan. To address this risk, and challenges government design and adopt climate-friendly policies, including appropriate fiscal policy and reforms in public financial management. Other critical support mechanisms, including various financing instruments to private and public sectors, such as disaster risk insurance. The topic of insurance development is of great importance for Tajikistan, and I think it's Central Asia region countries. My understanding is that disaster risk insurance markets are early stage on development in Central Asia, including in Tajikistan. This early stage presents both challenges and opportunities as we work to create an economic environment that can withstand risk and become sustainable. On average, 400 natural hazards and climate-related events occur in Tajikistan each year, which negatively affects the economy and population. Climate change also has a direct impact on the country's food security situation, especially given in Tajikistan's fast-growing population. In this context of challenges, establishing a targeted disaster risk financing and insurance financing mechanism is critical to address the current and future climate risk and ensure our country's sustainable development. In response to these challenges, the government of Republic of Tajikistan developed in September 2022 and started the implementation of a new green economic development strategy for 2023 to 2027, which to expand renewable energy generation and adopt fiscal policies at reducing emission, biodiversity, and climate adaptation. I am pleased to announce that Tajikistan has recently taken a significant step forward by adopting its first disaster risk financing strategy. The objective of this government policy is to improve financial stability and disaster preparedness, such design and use of insurance mechanism. To support implementation of the strategies, the Minister of Finance is working very closely with our partners, including the World Bank. The development and use insurance mechanism under the strategy is a part of our priority action, along with a number of the measures such as the creation of special reserve fund for natural disasters. We recognize that implementing the strategy requires extreme patience, financial and human resources, significant effort, cooperation, and partner experience. As we are just beginning this line of approach, we are ready and willing to learn from experience of the others who have addressed successful similar challenges. It's great to have an opportunity to be a part of this forum where we can learn from the best practices. Now we are focused on effective implementation of disaster financial risk strategy. This including building the necessary institutional capacity, creation of favorable regulatory framework, and the creation of advanced instruments for disaster risk financing, including insurance. We are ready and willing to work with international partners such as World Bank, private sectors, stakeholders, and the broader community to develop innovative risk financing solution adopted to our unique context. In conclusion, I would like to express once more our gratitude for your hospitality and organizing this important dialogue and for the opportunity to be a part of this activity. We are looking forward to participate in the fruitful discussion, sharing ideas, and building partnership that will help us to put forward our disaster risk financing agenda. Let's work together to create a more sustainable and financially secure future for everyone. In conclusion, I would like to wish you a good health and success in your new creative endeavors. Thank you very much. Thank you.
Thank you. you, Honorable Minister, and also thank you, Ivo, for your opening reflections, obviously offering perspectives from a national government and strategies being employed to better manage risks and the role of insurance within that. And also, obviously, Ivo, for giving us a steer in terms of the expectations as it relates today. With that, we are now going to head into the really substantive discussions. And I would like to invite Ruth Lux, who is the head of Europe, Middle East, and Africa Public Sector Solutions at Guy Carpenter, to lead the conversation that we will be having on reforming the international financial system and the role of insurance. Please welcome Ruth to lead us.
So I'm delighted to be moderating the session this morning on reforming the international financial system and the role of insurance. And we have rather a lot to discuss, and as always, a limited time to do so. So I will keep introductions incredibly brief. So firstly, I'd like to introduce Michel, who the majority of you will know. He is the chair of the IDF Steering Committee and also the chair of Zurich. I would then like to welcome Pablo Saavedra, the World Bank's Vice President for Equitable Growth, Finance and Institutions. And I would like to welcome Baroness Shriti Vadera, Chair of Prudential and co-chair of the World Bank Group Private Sector Lab. And I would also like to welcome Jacob Mazalale, Permanent Secretary of the Ministry of Finance, Economic Planning and Development of Malawi. And Jacob, I'd like to extend on behalf of the IDF our condolences for the tragic event that took place yesterday. So over the past 5 years, we have witnessed a rise in voices advocating for comprehensive reforms to the international financial architecture to immediately address spiraling climate and development crises. Now, I'd like to expand upon this slightly to set the context for our discussion this morning. We have seen in response the World Bank Group launch its private sector investment lab in 2023 as a collaborative initiative with CEOs of leading global private sector institutions to develop specific approaches that can be implemented and scaled by the World Bank to mobilize private capital more effectively. And we really do need to look at how we can integrate that with the development priorities that must be addressed to achieve a world free of poverty on a livable planet. So we will get into more of the detail on that later. I'd like to highlight that this session will explore very specific proposals emerging in the context of the private sector lab, of relevance to the insurance community, as well as broader reform efforts that are underway within the bank to match the increasing expectations of countries, many dealing with spiraling debt crises and at the same time increasing shocks. So with that in mind, I'll turn to Pablo, my far left, initially, and we're all very well aware of the frequency and the intensity of disasters and climate shocks that are taking place globally. How is the World Bank responding to the climate crisis to increase financial resilience of countries and people against disasters?
Thank you, and good morning to everyone, and thank you for the invitation to this panel. Let me start with a fact to give context to your question as well. If you look at the financing for climate in emerging and developing economies, excluding China, you will find that around 84% of that is going to climate mitigation. Only 16% of it is going to adaptation. And 98% of that climate adaptation financing, which is already very small, is mostly public sector budgets and so on. So you can see immediately that for adapting to those more frequent shocks that you mentioned, there's not enough resources. There's not enough resources globally for that. They are not flowing, and there's not enough in the budgets, and the needs are huge. So what are we doing in the World Bank? The first thing, this year we ramped up the work that we are doing to have a toolkit for countries to face vulnerabilities to climate shocks. One first measure that we took is the one on CRDCs, climate debt clauses. Basically, that allows countries to not pay principal on their debt in this case to the World Bank for 2 years when they have a climate shock. We have implemented that already. Second, we have allowed countries to use and disburse balance in their portfolio, which are very significant amounts of money, to move them immediately, reallocate them immediately to respond to climate shocks. That's the second measure we took just, again, this year. Third, we have expanded the access to what we call our catastrophe and disasters drawdown option. That's basically a budget support, resources that go to the budget when a catastrophe occurs. That had a number of limitations in terms of the countries that could access, the amounts, the timing, etc. We have lifted all those of those constraints, and now there's full access. And fourth, we have significantly also increased our support to countries on cat bonds, basically catastrophe bonds. We have been working on those for many years, and in the insurance sector, you know these products very well. But we have moved from working, and obviously we still work with Mexico and Chile, etc. The last one was with Jamaica, and that requires a different type of engagement, different kind of support. So we are doing that. And now we need to move further into developing, and that's the work ongoing and ahead, which is developing the capacity of agencies at the government to be able to pool risks, get in touch with insurance companies, create products that can serve the broader population. And we have, you will hear about the example of Malawi, which is, I think, a very good one. With engagement of the bank, but we have also worked in Mozambique, and we are working in several countries on that front. And maybe in the second part of the discussion, I'll go into more detail into this. But there is a need to, and we're working on it moving forward, to expand the insurance options in the countries. And I think one key point of this is to foster public-private partnerships with the insurance sector and the governments to pull together the resources and offer insurance to a broader array of the population. But let me come back to that in the second round, because that requires some detail.
Well, yes, I mean, I think it'd be great to address some of that. In the spirit of what Ivo touched upon, this unique opportunity to have such a diverse audience, I think the lessons learned from the World Bank in that regard will be really instructive. So if you could expand on how you see that contribution of evolving public-private partnerships in the insurance market, in closing that gap, I think that would be interesting.
Sure. So think about the landscape of protection in the country in terms of insurance today. So you have the very high-income individuals and large firms that are covered by regular insurance, local insurance, reinsurance outside. And you have the largest set of the population that is uninsured, and small firms that are uninsured. They all face shocks. Now, that sort of those separated buckets need to change, and are changing already in some countries. That needs to be scaled through public-private partnerships. Let me give you a concrete example. Morocco. We're working, we worked and continue to work in Morocco on a PPP, basically, where you have basically a set of traditional insurance, but also a solidarity fund. And through that solidarity fund, and with support of the government, because you need some subsidy of the government, then you can cover a wider range of households and individuals. This was for earthquakes, but the same applies to climate risks. We are doing a similar, contribute to a similar thing in Indonesia. In Indonesia, you have a very large set of public facilities, think schools, hospitals, that are in areas of the country that are very prone to disaster. They were uninsured. There's a PPP was formed with a consortium of insurance to cover those with the support of the government. So again, there's a huge space to go into the PPP space and get to cover more households and small firms that are uncovered.
Thank you. I think we'll build on that as we move through the discussion. Turning now to Baroness Shriti, I've heard you speak previously on how important it is that the private sector really understands the full range of innovative financing structures that are available. So with that in mind, could you elaborate on some of the innovative financing structures that the lab is exploring to mobilize private capital more effectively? And how can these structures be tailored to address those unique challenges by emerging and developing countries?
Thank you very much. So I should start by saying when Ajay Banga set up the lab last year that I co-chair with Mark Carney, we agreed that we were not going to do a report. You'll be pleased to know that, because we won't be felling any more trees in the process. But we were going to really focus on very practical ways in which the private sector and the World Bank can work together for the World Bank to leverage in more private capital for every dollar that it lends or invests. We have focused on finding things that are scalable and standardizable and replicable, because when we talk about the sums of money that are needed, they are enormous. People, you go from one COP meeting to the other and they're talking in the trillions. And that doesn't come from very tailored, bespoke solutions. And I know that in our sector, we're used to a more tailored, bespoke approach sometimes, but we do need to start to find things that are standardizable and replicable. So we started by thinking about, in particular, emerging markets, climate finance for mitigation in emerging markets, and emerging markets that are, at this point in time, investment grade, because that is the smallest gap to bridge to start with for what could be made commercial for the private sector to insure, invest, finance in whatever form. And we looked at 3 or 4 areas. The first was guarantees, because it's the easiest, most easily understood instrument that the World Bank and other multilaterals can currently provide. And we're really delighted with the progress that they've made. They have agreed that they're going to treble the flow of guarantees that they will provide to private sector for climate and development financing to 20 billion per annum by 2030. But actually, even more important than that, they're going to do it in a single platform, MIGA, IFC, all of them, in one single platform that is easy to use and access for the private sector. And that's really important, because one of the problems is, in a very tailored, bespoke approach, is you don't actually know what's available. So it takes a long time to get there. For us to know exactly this is going to be available on roughly these terms, we can start to look at some of the projects. So that's really important. We've looked at a couple of other areas, including foreign exchange risk, which is a very significant risk that is a barrier to private investment. And I'm very pleased that Pablo is co-chairing the working group on that. So we're waiting to hear what he's doing it with John Condolfo. That is really critical because it has come up in all of the discussions as a very key risk. I think that Mia Motley talks about it as well. Early stage capital is really important. It leverages the most amount of private finance. However, it's very heavily risk bearing, and we're hitting barriers like the fact that the World Bank itself has, of course, got capital constraints and needs to finance a whole bunch of other things, and that could be quite risky for them as well. And it is an important lesson in us not talking generically about leveraging private finance, because it's about where you're leveraging, in which market and with what instrument. And we would love to see more early stage capital. It's one of the biggest gaps for climate finance. But the risk allocation inside the World Bank needs to consider this option given its own capital constraints. The last is something that I think is somewhat of a holy grail, which is securitization and originating to distribute. And the reason is not just because if the World Bank was doing that and then on selling to the private sector, that it would release more capital for itself, but much more importantly, to my mind, is the fact that we should be thinking about creating an asset class that is tradable, that's a security that is tradable. Because if we want to talk about the trillions, we need to access those institutions who do not currently play in this market and who really would only do that if they were able to trade in an instrument. Now that needs volume, and volume is extremely hard to create for climate finance in particular, because quite frankly, we don't create the flow of projects. It's very hard to securitize the existing stock. It wasn't made to do that. But if we were able to do that, that would start to create a different participation from the private sector. So those are the sorts of things that we are looking at. I would just give one word of warning, which is that when we talk about the big aggregate numbers, people don't have clarity about what it is the private sector can do and what it is it can't do, and what no amount of bridging is going to really, frankly, make commercial in the parameters that exist today. And so we do need to, in whether it's a colloquium or a sort of action group or whatever it might turn out to be, we need to be very clear, where will the public sector have to step in? And actually no amount of bridging and risk sharing will do the trick. Or if you really want to change the parameter, we need to start to think about carbon mechanisms in a very different way, because you can't expect the private sector and insurers and others to kind of spontaneously combust and make commercial something that genuinely isn't, unless there is some form of carbon mechanism.
Perhaps I could put a quick fire question to you.
Sure.
A quick fire question to you in light of time limitations. Where do you see the greatest opportunity for collaboration between the World Bank and the insurance industry that can be unlocked by the lab?
I think that one of the things that we fail to, we don't pay as much attention to, because we are all international, companies, and we talk about cross-border flows. But we've got to remember that the funding that's going to come from domestic markets, domestic funding, is going to be much larger than the cross-border flows. Right now, multilaterals don't really support and play in that space, sometimes for constitutional reasons, sometimes it's just not what they're used to. But if you're an insurer, take the Prudential that I chair, we're a life and health insurer, which means long-term, and we create long-term liabilities from our customers, and we want long-term assets, which is the perfect approach to creating domestic capital markets, developing domestic capital markets. It also, of course, leads to financial inclusion as well. It deals with the FX risk. But we don't get the support from the multilaterals that we could get, because they kind of view themselves as mainly cross-border. But that domestic capital market is going to be double the size of the cross-border when it comes to climate finance.
Thank you. So Ivo mentioned this earlier. Yesterday, we had a fantastic knowledge day, an inaugural knowledge day between the World Bank and the Insurance Development Forum. And it was wonderful to see the exchange of knowledge peer-to-peer, and great to hear from Jacob as part of that day. Jacob, turning to you, Malawi is highly vulnerable to climate shocks, and your DRF strategy highlights a very proactive approach from government to help manage the financing risks. So can you share some of your experience in this forum with this audience of how you're managing those risks, including through insurance, and how you think the international financial system can strengthen your financial preparedness further?
So thank you very much. First of all, let me thank the IDF, the World Bank, for such a wonderful function and inviting us and giving us a platform that we can participate and share some of our experiences. Let me also, as you mentioned, start by celebrating the life of Chilima, who was announced yesterday to have passed on in that fateful plane crash. He was our vice president, and he actually worked in the ministry that I'm working, and he, to a smaller extent, worked on climate finance, so we celebrate his life. So about Malawi, let me start by giving just a small overview of the country, the challenges, and also our involvement in the discussion that we're having now. So Malawi we are in the southern eastern part of Africa. Just in case some of you are not here, we are a people of about 20 million and among the poorest in the world, with high levels of poverty and hovering around 70% or so. As a country, we have limited access to finance, very limited fiscal space, high levels of domestic borrowing, small tax base, and that results in high levels of macroeconomic constraints. So recently, the IMF described Malawi as in debt stress. Given that context, that leaves us very vulnerable. I think it has been mentioned that the poorest are the most vulnerable to climate shocks and events. And that is, I think, why the whole issue of adaptation, of resilience is important. Yesterday we had the discussion of loss and damage. I think she mentioned the 4 trillion in terms of loss. To us, it's not a figure, it is the experience. And I think that message, has to be put across. We are ranked 161 of the 181 in terms of vulnerability to climate shocks. And with, I think, recently there's been mention of the increase in frequency and magnitude of the shocks. The effect, I want to say, are not linear. They are very interactive and therefore multiplicative. I think that is an important point that we should not overlook. If you look at the past 4 years, 4 or 5 years, when COVID hit, we were hit by 2. In the midst of COVID, we were hit by 2 cyclones. And that affected lots of things, which resulted in a cholera outbreak. And then we were hit by yet another cyclone. And last year, we were also hit by yet another one. In the current year, we have a drought. And it's really not just a drought, because the drought is more popular because this is where we get a drawdown. But we are in the midst of an El Nino, and the way it affects Malawi is in a very interesting way, because the southern part of Malawi is a drought, the northern part is flooding. So both of the events are not good in any way. They actually leave us more devastating. So this is the way I think it is important to look at them. And so you have COVID and the effects are really very daunting on the economy. And I think only this, because we are on the path from Mozambique to Malawi to Zambia to Zimbabwe. Just a small point there. Some of the interventions, let's think of them in a regional manner, because you would find one cyclone affecting parts of Mozambique, not the whole of Mozambique, but they affect Malawi, Zambia, and Zimbabwe. And these are probably parts of these countries, not in all. You'll find that Zambia is intervening in a different way, Malawi isn't. But if we come together, probably it would be more effective. I'm glad Mozambique mentioned, put a point yesterday. So I know that there's the repair project from the bank. I think we are looking forward. We have the Regional Climate Resilience Project, which just became effective recently. And we are very glad, at least in this regional kind of setup. And also, I think it's time that we as countries, we also start talking, given that support. But that really, I just wanted to give you a picture of our vulnerability to these shocks. With high levels of poverty, makes absorption of the shocks very complicated. And that's why these interventions that we're talking about become very important. Yesterday was a discussion about the private sector participation in these things. So in Malawi, with these shocks, the private sector has in no way been spared, highly affected. I think in Malawi experienced about 22 million claims, which the market actually failed to satisfy. And there you go, the conversation about building capacity. And I think yesterday was a very good analysis of what type of capacity, the financial capacity to pay, the technical capacity to handle these issues. I think all those conversations, the private sector capacity to participate in managing, mitigating, and adapting to these climatic shocks. I think these are very important.
Yeah, just a closing sentence.
So in closing, because our little experience, we have had several interventions. We have had recently the drought program just triggered. So we drew some 57 million from the bank. We also are drawing very soon about 6 million from the ARC policy that we have. And we think these are important, and they are helping in a conversation also locally about the importance of participating in these insurance efforts. I think that is important to know, because we have participated in this insurance and we do not manage, but recently there are these drawdowns that we're making, and the conversation is kind of changing, showing the politicians, the community, that if we invest in these premiums, we can at least manage to mitigate for some of the effects. So in a nutshell, we have a lot of experience, but I would stop there. Thank you.
Thank you. I think we can continue the discussion in the break. So in the interest of time, I'm moving us forwards. Michel, I've heard you mention to a number of us in various fora that did we make a mistake to not establish world insurance at the same time as the World Bank? Now, given some of the challenges that the world is facing, is there unfortunate stars aligning that necessitates considering
First, I'll try to be short because I think I need to take care of the resilience of the Insurance Development Forum. My poor Ecosway is looking at the agenda and she's close to the heart attack. So I will be very close on very short on that one. I will avoid the we should have done 80 years ago because Ivo would criticize me. But I think it would have implied, it's not the creation as such of a world insurance, and probably the reinsurer could say that's the role that they are playing. It would have implied a more natural inclusion in all the discussion about the problem that the country faces with the insurance industry. What is difficult for me is to admit that if you meet finance minister, you never meet somebody who knows about insurance. They know a lot about what is happening on the asset. They don't know about the liability. And I think that's lost time in the discussion that we have with a lot of the political responsible to have to explain to them what insurance can bring before we come to the solution. So that's the main element that I would have brought, that would have brought the creation of a world insurance. But again, let's avoid the should have done 8 years ago. I think one of the key elements, and I don't like to ask the system to change because everybody has to do their own things, and I think the insurance industry as one challenge is probably to move a little bit from the financially protection, to probably be more active on the prevention. So definitively working in the prevention and probably also taking into account the enormous amount of asset that we have in which we can, and we will discuss about that later on, that can be partly sometimes invested in infrastructure changes. One element, Mark Carney has been mentioned several times this morning. A few years ago was created a group resilience, global resilience index, which could be a nice complement to these famous rating agency standards, which is giving a perspective on the resilience, not only on the snapshot of the financial health of a country, of company, and things like that. And I do believe that we need definitively to work permanently within the financial industry, but not only the financial industry, to make sure that this resilience dimension slowly gets included in the rating agency notes that are given to corporation or to state. It will then make things more clear, and I think it will probably attract also investors to place which are doing what you are doing in your country in order to make definitively resilience a real aspect. So that's for me the key element. We need to get a little bit rid of this financial immediate snapshot, but having also a long-term perspective about the way in which we judge corporation and the way in which we judge state in how they prepare themselves to resilience and to the world that we are facing.
Thanks, Michel. So we are over time, so we will close the panel there, but please do join me in thanking our wonderful panel, Jacob, Michel, Baroness, Shriti, and Pablo.
Obviously, that conversation was about bridging some of the global policy developments that we're seeing, if it is with the Bridgetown Initiative, if it is with the private sector lab, the reform conversations, but also what is happening at a national level. And so I'll now like to invite us, after that conversation, to turn to what are we seeing in terms of the complexity of the risks that are emerging, and again, what are some of the solutions? And we started to hear Michel reflect on the Global Resilience Index, etc. So I would like to invite Dr. Nicola Ranger, who's the leader for the Resilience and Development Group at ECI within the University of Oxford, to moderate this session. There's also another point that I would like to flag, which is that at 10 a.m., an alarm will go off for 30 seconds. So please do not run for the exit or panic. It is part of a standard test of the facility, so I just wanted to put that out there. And perhaps it's also apt because the title for this session is Global Uncertainty and Future Risks. In this instance, we have a sense of what is coming. So over to you, Nicola.
Hello, good morning, everyone. My name is Nicola Ranger. I'm based at the University of Oxford. I direct the Resilient Planet Finance Lab there. So as Ekoswe kindly introduced, we're going to focus this session on how insurance can help us deal with the complexity of the growing landscape And actually, I want to slightly change the title of the session, Equitable, which is, so that the title of the session was around growing uncertainty and the role of insurance as a risk manager. But I think actually insurance plays a much more important role than that. And I'd like to make it around also de-risking and enabling investment and growth across the economy. As I call up our excellent three speakers for this morning, our three panelists, so firstly, if I can introduce Ken Mungan, Chairman of Milliman and member of the IDF Steerco. Secondly, Samye Kiovande, Director for Department of State-Owned Enterprise Reform and Insurance at the Ministry of Finance of Government of Laos. And finally, Rachel Delhazy, Head of Sustainability for Convex Insurance. This is wonderful. It's like an award ceremony, isn't it? It's brilliant. It's lovely, lovely to be joined with you all this morning. So actually, as a couple of words of introduction, I actually just want to take a moment as well, to take a moment and just appreciate the surroundings that we're in here. Now, what an absolutely amazing facility. And also appreciate the fact that, you know, we're all sat here together. Some of us have been here since the beginning. So I joined this journey in around 2016 when I was working at DFID at the time. I know IDF has been around for slightly longer than that. And we've brought together this community over time. But as you're sort of appreciating this beautiful landscape, I want you to have a think about, you know, what it means in terms of thinking about insurance. So what analogies for insurance can you think about from this wonderful landscape? Just take a moment to think about that. And I guess, so for me, it's actually thinking about clarity. And a big grey cloud has appeared before I first had this thought. But clarity, I think the role of insurance is really about clarity. It's about helping the world understand these risks and to see clearly enough and with enough security to enable that investment and growth over time. But as we heard from the introduction, the world is facing many more risks, a really growing risk environment and more interconnected risks. And actually, if you look around and you see these buildings here, which are, you know, all of our financial sector in the UK, all of these institutions are connected globally to every other institution in the world. And many of them are managing risk in some way, be it currency risk, looking at capital allocation, looking at insurance. We're interconnected in our supply chains. We're interconnected here in this room from all around the world. And that interconnection, in addition to climate change, biodiversity loss, is creating a much more complex risk environment as well. And I think insurance has to play a really important role in helping us to manage that more complex risk environment. Insurance has survived and thrived and evolved in this more complex risk environment. And so that's really what I want to hear from our speakers today. You know, how, to your mind, how can insurance help us to survive in this new world and actually make these investments in adaptation, but also other areas as well that we need to make? So if I can first come to you, Ken, to talk about how you see insurance bringing expertise in this area, and particularly the work that you've been doing as part of the Global Actuarial Initiative with UNDP.
Thank you, Nicola. So how can insurance help? It's very simple. Insurance is the foundation. As we learned yesterday, listening to the Prime Minister of Barbados talk, if you're not insurable, you are not investable. Insurance is the very foundation of the economic system, and without it, all of the follow-on economic activity simply doesn't happen. And so if you look at that insurance system, well, what is the foundation of it? Well, it's very nerdy people like me with mathematical expertise. I am an actuary. And all throughout the developed world, you find tens of thousands upon tens of thousands of actuaries that do their very unfashionable work every day to make the insurance system work. But when we look at the developing world, we don't see them. They simply are not there. So one of the points that was made in the discussion yesterday was about the fact that, when you look at the developing world, the data is not there. Why is the data not there? because the human beings with the expertise to create and analyze that data simply aren't there. So when at Milliman, we took Ivo's message this morning to heart. Let's not talk about, what shoulds, let's talk about, what can we do? So we convened a few years ago and said, well, what can we do to help this? Let's create the Global Actuarial Initiative. So we worked with the United Nations Development Program. So I've got my treasured colleague, Jan Kellett, here. And I called him up one day. I said, Jan, I've got a great idea. Let's create a program to create actuaries all throughout the developing world. And so we've done that now and gone to 10 countries. So we've been to Ghana, Nigeria, Ethiopia, Egypt, Nepal, Tanzania, Uzbekistan, Colombia, Ecuador. So we've working with the UNDP because they have the local country offices. They have staffs, teams of people. So then on the Milliman side, we send in teams of people and we train actuaries at universities. We work with the regulators to help them understand the need for actuaries. We train actuaries at the local insurance companies and so on. So and now we're ready to expand the program. So we're bringing more members into the Global Actuarial Initiative to kind of get that core of human expertise where it needs to actually be to make a difference. So that's kind of one small piece of the puzzle. It's what we felt that we could do. For those who aren't familiar with Milliman, we've been around for 77 years. We are a global center of actuarial expertise, and so we're happy to play our part.
And can I just sort of expand that as well? Because in this more complex world, we need to, I think, balance local solutions, and we've heard a lot about the local solutions already this morning of sort of inclusive insurance versus dealing with these big macro trends and macro solutions as well. Can you offer any insights on how we can do that?
Sure, I'll be happy to. Often, when we're sitting in a building like this, and we talk about things like, sovereign risk financing mechanisms, cat bonds. We think on the very grand scale. With inclusive insurance, we're thinking much more on the human scale, the scale of a single person, of a single family. And when we think in particular about this conference, prevent, protect, provoke, on that scale, it brings us all to the very thought that we're sharing right now. What are we thinking about? My goodness, how can we protect that guy who's washing the windows? Have you all been watching him? So we want to, the insurance industry brings expertise to prevent. We want to prevent him from having a horrible accident. We've all been thinking that in our heads. But we want to make sure, okay, well, he needs all kinds of insurance to protect himself, to protect his family. And, I certainly hope he's got workers' compensation coverage. So I hit on prevent, protect. What about provoke? I provoked laughter when I brought this up. So, it's that inclusive insurance is at that very human scale. It's one piece of the puzzle. If you think about all of the different elements of the insurance system, they all have to fit together. And in order for it to fit together, the critical piece is trust. Insurance only works, and in particular, inclusive insurance only works if the people trust that it is going to actually protect them, that it's going to deliver on the value that's promised to them. And so that's, the system to build that trust drop by drop over time. It relies on the system having the transparency, the data, the analysis that's available and easily understood to people so that they can see, yes, it's going to protect me and my family when I need it most. So that fellow washing the windows today just knows that, at a very visceral level.
Thank you. And I've been thinking about that gentleman as well, and he must have heard that workers' compensation joke a lot of times, given that he's cleaning the windows of the Gherkin. But, and I also think about, is this maybe an analogy to actuaries in some way as well, in sort of cleaning up the uncertainty of that's preventing the clarity. But maybe if we can come now to you, Sonia, to hear about your perspective from the government of Laos. So what are the risks that you're facing, particularly to your fiscal resilience, and how are you hoping to work with the industry to help with that?
So first of all, I would like to thank you. It's very exciting for me now. But for the trees that we have now, in fact, now we have faced a lot of challenges, ranging from fiscal, macro and fiscal constraints. This would be the rising on the debt, exchange rate fluctuations, and high inflation also. This consequence from the COVID-19 and also the climate and risk shocks. In order to respond to this shock and challenge, the government tried to put in place a number of measures ranging from macro policy to financial social safety net. This including mitigation of the risk thanks to the World Bank program that we have disaster risk management program to help us on the accessing to risk transfer that we are the one who buying the CDF insurance company, CDF insurance to protect our countries. But we also pilot a lot of number of different way of financing in order to bridge the financing gap for the countries. But for this, I still find that after attending this event, I feel a lot that we can learn, and there are many areas that we can help, especially the insurance. But the problem is that the understanding on the insurance and how insurance can help the government or the industry is really crucial. Especially in my country, it's like people are normally people they understand insurance, but not really what the insurance is. Mainly the insurance now are in the commercial areas, commercials business, not really on the households. But the household is the one who more affected from the disaster when it happened, and the insurance itself should be more awareness raising, and there are more role to play in Laos. And even we are the small market, but I think that with the cooperation with seeing the importance from the insurance market, I think that would be potential for Laos also, since we also have the big project over there where the market can grow. Yes.
Thank you. And how are you thinking about the sovereign versus protecting businesses and protecting individual communities? Do you have a sort of roadmap for that? Are you looking at these things at the moment?
For the roadmap on this, in fact, we have to first we have to not have really the system yet, but we have disaster financing strategy that we could have. What we have to do, like to build the regulatory environments, landscape, and also to educate. I would say that to government agency to understand on the insurance and how can they get on board to help on the implementations. But we also see the importance of private sector that can play a role. But as of now in Laos, I think the insurance market or the insurers, they now focus on the normal product that they can make benefit from that, but they do not really thinking above beyond that like micro insurance that maybe we also need as the government. We also need, since we have like agriculture's product and agriculture's worker over there, and they are one of the vulnerable to disaster and shocks. And I think we as the government or as the regulators, I think the government can play a better role in facilitating the public-private partnership and also bringing in expertise from abroad to the local to develop local market. Maybe on the doing like Indonesia, like grouping all the insurers with a better capacity to absorb the risk within the countries, and also the join hand with the other big players of the reinsurance market to better manage the risk within the countries. Thanks.
Thank you. And I want to now come to you, Rachel, particularly to hear about some of the scientific approaches in this area. And I know you mentioned CDRIF, Sonia, as well, which I know has done some really brilliant work on the scientific side of how you use Earth observation data to design this new flood insurance instrument, which is a real sort of sign of how the industry can move and support countries like Laos. But coming now to you, Rachel, can you talk a little bit about how the industry has evolved to date in terms of its use of the science, and also how the industry can help us think about the future risks rather than the sort of standard backward-looking approaches? What can we learn from the industry on that?
Well, I think Rowan told us yesterday about quite what the industry was like before we had a world of modelling and sort of more scientific aggregation of insurance, which sort of came in post Andrew, etc. But what this has enabled is it's not just that it's given us a better lens through which to look at the management and aggregation of risk, but it's also allowed this transparent quantification allows for greater risk transfer. So where a good example of that is, and we'll hear I think more from that later on, is our friend from Morocco, where the modelling of the quake risk enabled the transaction that they had in place that allowed them the indemnity that from a parametric triggered policy that allowed them to recover from that after the devastating quake of last year. So but a modelling of that risk was crucial to that. So but one of the issues is that this is an expensive thing to do. It's expensive, it's complex, it needs really sort of tailored and focused resource. So the Global Risk Modelling Alliance that the Insurance Development Forum has set up, focused on the V20 countries, that facility and that alliance is there to develop, to bear the frictional costs and enable or create an enabling environment for modelling for those geographies, for those countries. And it's been, so the German Development Bank is one of the key entities which is part of the finance that, as are a number of insurers behind the IDF. So this helps, not only does it help pool the resource, create platforms from which countries where it may otherwise be challenging, but also what we want to do is build that local capacity. So that modelling capacity that sometimes exists, but it could be strengthened through use of a platform that I've described. That's where that is the purpose of. And again, I would emphasise that the frictional costs of that are borne by the finance that's underpinned it. So that should enable, not only should it enable the building of local risk management and capacity to model, but also this risk transfer environment that we need.
Thank you. And I don't want to come back to sort of the key topic of this session, particularly around these sort of complex risks and new complex risks. And we're seeing an environment of sort of growing macroeconomic uncertainties, more climate-related disasters, but also pandemics, more volatility in commodity markets. A whole series of new risks. Maybe if I can sort of open it up, or to you, Rachel, how are our techniques having to evolve to deal with this more complex environment? And do you have any examples?
Yeah, it's interesting, isn't it? The insurers have looked at emerging risk and horizon scanning certainly for almost my entire career in the insurance world. There's a good example of the Lloyd's did a pandemic scenario back in 2013, which was almost a replica of what then happened in 2020, but we didn't really pay enough attention to it. So we're quite good at envisaging scenarios, but I'm not sure that we act on them or treat them as seriously as we should do. However, as concerns climate change, it's very clear what is happening. And what is happening is greater uncertainty. That is very clear. There are certain hazards where it's much more definite, and therefore we need to develop the risk management around that. So, whether it's flood, wildfire, etc., we know in certain geographies where this is the impact is greater. And then there's the added complication of this being a systemic risk and well-documented links between drought and the global food supply chain, etc. So there are tools being developed which sort of based on modeling techniques, but where you then take a scenario and you adapt the inputs, and then that allows you to look at, in terms of a specific warming scenario and looking at particular hazards, particular geographies. There's a tool called Magnify that we've helped support the development of that will allow us, and we're sort of looking forward to using this, will allow us to use a more nuanced view of some of these climate scenarios and other impacts of changing exposure managements, etc. So that's one area. But I think, once we understand that risk, the impact of it better, what are we going to do about it? It's no good. It's not going to lead to a more sustainable world if we simply walk away from geographies and parts of the economy which we deem uninsurable. So we have to understand how, so I think one of the key solutions there is what we do about resilience. And as was discussed last night at some length, was the need for increased links between governments and insurance, and how we're building resilience. We've talked a little bit about the flood example of Build Back Better, how they've inputted that into some of their policies. But actually, I think that, frankly, that needs to become policy. Stuff like that needs to become stronger policy. And then we need to think about how private finance can help be a part of the solution and the insurer's role in that. Again, I think we'll hear later more about the infrastructure investment fund. That's a good example, but it's how, so could that model, for example, be leveraged for a greater focus on resilience? Could you use the asset side of insurers to build up that and thereby make some of the areas where a protection gap exists and will continue to and will grow? How can we make that more insurable?
Thank you. And I wanted to just have a last question, maybe a sort of slightly wildcard question to the group, because one thing that I'm very passionate about is I feel that one of our challenges in insurance is that we present it as something which is dealing with a negative thing. So it's presented as a negative, reducing a negative, when actually it's creating an enormous positive, which is resilience. And actually, can we change this narrative, as you've said to us? How can insurance support resilience, support investment? And can we capture that in some sort of metric in some way? And that's something that we're thinking about in the Resilient Planet Initiative, which is another IDF-supported initiative. I think it comes back to Shriti Vadera's point earlier as well about, how can we make an asset class of resilience as well? So any thoughts on that? How can we quantify the benefits, the resilience benefits, and articulate that better as an industry as well?
Well, there's examples like coral reef, either coral reef insurance, and then you're using sort of biodiversity or carbon credits to as a way of financing. So I think we just need to be sort of creative in how we think. We need to drive finance in there. How, and either are you building? How can assets be built in that territory? Can resilience measures be taken through natural solutions, etc.?
Thank you.
If I can add on that, I think one of the things that insurance does is it allows societies to move forward. It allows them to explore new models of economic activity that without the risk management tools of insurance would simply be unavailable to them. So, for example, if you look at the developing world, developing countries have an opportunity to try economic models that you don't see in the developed world. For example, what I call the strategy of decentralization. So, in the developed world, very often we meet our fundamental needs, whether it's generating power, getting clean water, managing waste, transportation, and so on, with very massive infrastructure projects that are, that require a certain amount of kind of economic capability to pull off, that simply isn't found in the developing world. But now today, if we think of a family putting a couple of solar panels on the roof of their home and getting power that way, of having very small, locally available means, that family is able to get power in a way that wouldn't be typical in the developed world. But think about what just happened. Now we have a family that is essentially gone into the business of producing power. So as that business, the primary, if there's a primary breadwinner, that person needs health, disability, life cover, that the equipment that they have now needs the property and casualty coverage and so on. So it's, having the way to manage the risk allows people to actually engage with new economic models, and then the economic growth from those models is really what needs to be quantified to say, okay, that's the benefit of insurance.
Can I offer a final word?
Yeah, I think technology now is very advancing, and if we could use it and bringing it to the insurance sector and help us, or help especially developing countries on how asset information for us to plan for our financial planning for disaster instrument, that would be also helpful, because I think many for the company, the insurance company with the consortium with and also developed country, they have some, but for developing country, I think is not easy. And I think sharing with our developing country would be good for planning for the futures. Thanks.
Thank you so much. Well, thank you to all of our three wonderful panelists, and thank you to you all.
Thank you, Nicola. Very, very well handled. And I think that panel was really an excellent basis for the next session, which is on mobilizing insurance sector investments into resilient infrastructure in developing and emerging markets. So I would like to invite Bill Marcoux, who is a partner at WCM Advisory and also co-chair of the IDF Infrastructure Task Force, to lead us through this session. And I will also just say thank you to Nicola for the excellent time management. I think that we're in good shape now. So over to you, Bill. Welcome.
And as they get settled, let me just say I'm Bill Marcoux. I chair the Infrastructure Task Force of the IDF, as Equitable just said. I've also just generally hung around the IDF since it was first formed, doing a few odd jobs here and there, but it's a real pleasure to be able to be on this stage on this topic at this time. I will say, I watched that window washer, and I thought, I want that job. But it is with a bit of risk and risk mitigation requirements. So good morning. We're going to pivot the discussion away from the insurance industry's capabilities on risk financing and risk understanding and mitigation and adaptation to look at the asset side of the balance sheet. It's a massive component of the insurance industry, more than $40 trillion that the insurance industry globally owns and needs to deploy. There's been a lot of discussion for a lot of time about why more of that balance sheet is not deployed into investing, particularly in infrastructure. There's other areas that it could be deployed to, but our topic here is really infrastructure. And there's really this conundrum that we've all been aware of for a very long time: massive need for infrastructure investments globally. The insurance industry has tremendous appetite to invest in infrastructure. Baroness Shriti talked about that, their long-tail liabilities, which match with long-term assets, cash flows. So great desire to do this, and yet to date, about 2% of the insurance balance sheet is deployed into infrastructure investments. So huge demand, great excitement from the industry and desire to make these investments, and anemic levels of investments. And so the question is why? So this has existed. Lots of initiatives have been launched to try to solve this conundrum. 5 years ago, Mark Carney hosted a full day event at the Bank of England with the IDF to focus just on this. He knew, he just couldn't understand, wanted to try to solve it. We spent a whole day. Then lots of other initiatives, the private sector lab, which we, at the World Bank just discussed about what do we do about this. Well, the IDF formed an infrastructure task force to try to tackle this, really from the perspective of the insurance industry. We know that there are many impediments to why insurers do not invest more into infrastructure. It includes asset liability, matching requirements, legal restrictions, regulatory burdens that come with making that type of investment, and others. But our task force knew, and it is beyond any doubt, the biggest hurdle, the biggest impediment is a lack of investable deals. Deals that meet the credit profile of the insurance industry, which is unique to other asset owners or other asset managers. And so we really turned our attention in the task force to let's look at that problem and see if we can come up with some type of solution. Not a silver bullet, but something that would change the game a bit. So we gathered together about 8 major insurance companies and their CIOs and their investment officers and worked for over a year to try to take, and what we did was we took the proverbial clean sheet of paper and said, let's write down on this piece of paper what we as the insurance industry are willing and interested in investing in. What type of assets, what credit quality, what structure, what format could this be? So over more than a year, we filled up that sheet of paper with a lot of very specific details, a lot of hard work and discussion among the insurance investment professionals. And when we had the sheet of paper filled up, we went out to about 8 major asset managers, all well known, and said, this is what we want to do. And we're willing to invest our capital, and we think others in the insurance industry would back this. Would you be interested in partnering with us, managing this and driving this forward? Got a great response, ran an RFP process. End of that process was the selection of BlackRock. And BlackRock's agreement and excitement about supporting us led to what is now a formal relationship and a partnership. And my co-moderator this morning is Matt Kaczmarek from BlackRock. He'll speak in a moment here and give you some more details on this, but a long career, not just at BlackRock, but also in development finance from the government side and others. But we've now created this, this platform, and we're going to launch it forward. And we hope and we want this discussion today to really talk around that, but talk around other areas and the abilities of the insurance industry to support infrastructure development. So Matt, I think I'll turn over to you now to give a little more detail on what this vision is, where we are in the process of really launching this, and then we'll get some input from the panel, and if we have some time, take some Q&A, but we'll try to stay back on the time that we've got ourselves back to. So Matt, over to you.
Great. Thank you, Bill. And it's wonderful to be here. Thank you for inviting us and having us today. A quick little background on BlackRock. So we are one of the world's leading global infrastructure debt managers. So we manage approximately $25 billion in assets across advanced economies and emerging markets. And we are also a leader in sustainable and transition investment solutions, managing $138 billion in sustainable strategies across the firm. And we really jumped at the opportunity to partner with the IDF because we see a huge market opportunity in emerging market infrastructure finance, and particularly in the resilience theme that Bill described. So let's start with the demand side of the equation, right? There's currently $1 to $1.5 trillion that is annually invested in emerging market infrastructure. That's made up primarily of energy, transportation, water and sanitation, and telecom. Energy, of course, is the largest component of that with 400 to 600 billion in annual investment, but there's a need to double that. And we could double that to $3 trillion annually with an additional $1.5 trillion in order to do 2 things: to finance the economic growth of emerging markets, but also to build resilient communities, which is really the theme of today's event. On the other side is the supply that Bill talked about. There's tens of trillions of dollars of insurance capital that is invested in global markets, of which only 3 to 5% is invested in emerging markets at all, and that includes mostly public investments in equity and debt. So our solution and what we've worked with IDF to put together has 4 goals. And again, today is all about action, so this is the action that we're taking. Goal number 1 is to bring insurance capital at scale to these undercapitalized sectors. And this is pretty simple, right? We know that the balance sheet of the multilateral development banks is limited. We know that the amount of capital that's available from commercial banks, who are the traditional lenders into emerging market infrastructure, that capital is limited, and that capital is actually getting smaller as a share of overall finance, both as the market grows and also as banks become more regulated. So much more capital is needed at market rate levels. But then that brings me to our second goal, which is to recognize that insurance capital, of course, is limited in how much risk it can take. And so we are developing a blended finance structure to efficiently reallocate the risk to unlock capital at greater scale. And the promise of blended finance is that you can split apart the risk in emerging market infrastructure investments so that investors, like insurance companies that need to take less risk, can take the bulk of that, and it opens up a wider portion of their balance sheets and more capital that's available, while also working with investors, public investors, private investors, who are able to take greater risk and strip some of that risk away. And we can blow open the doors to much more than the 3 to 5% of insurance capital that's currently allocated to emerging markets. Our third goal is to apply this overlay of resilience and the resilience framework, which is the theme of today's event. So that consists of 2 parts. One is ensuring that there's a building community resilience thesis that's attached to each one of the investments that's made through this project and this strategy. And the second is through very clearly identified sector focuses in renewable energy, water and sanitation, transportation, social infrastructure such as housing and hospitals, and digital and telecommunication. And then the fourth goal is to deliver measurable positive outcomes. So both applying leading ESG and emerging market infrastructure investment best practices and principles and frameworks, but also tracking measurable KPIs and reporting those to our insurance investors across community resilience, which can include CapEx and impact, expanded access to infrastructure and in the communities where we're investing, and support to the local economies, which can be measured through things like jobs and capacity and efficiency. So I'll spend just a second on blended finance, because that's a key feature of these 4 goals. And this is not a new market, but it is subscale. So the total blended finance market size today is about 160 to 200 billion, and the average deal volume in blended finance deals is about 20 to 25 billion. The typical debt fund size ranges from about 50 to 150 million. And BlackRock and the IDF together have grand ambitions to make this market much larger. We want to supercharge the growth of the market over time, and we want to build a multi-billion-dollar platform over time. And I'll give you 3 reasons why I think the IDF and BlackRock is the right partnership to make that happen. First is the scale that we bring. The IDF represents the largest global insurance investors in the market, and BlackRock represents the largest global investment platform in the market. We're building a global strategy that's going to be flexible to be able to find the opportunities, the best opportunities that exist as the market develops, and deploy capital into those deals. And we want to inspire the market, because as Bill said, part of the problem is there's not enough bankable projects, there's not enough ambition in the market, there's not enough of a pipeline, and we want to have big numbers and big scale in order to inspire people to develop the projects that we need and bring them to us so that we can make them bankable. The second thing we can do is we can align the stakeholders. As we know, there's many players in the blended finance space, and it takes alignment of the investors, the investment managers, the public sector providers. Everyone has to come together, and it's difficult to do that at small scale. It's particularly difficult to do that if you're going asset by asset by asset. So what the IDF and BlackRock could do is we can create a big table where we can bring together the borrowers, our deep relationships with governments, with the multilateral banks, with development finance institution, and our underlying investors, the insurance companies, to really tackle this problem and build a platform through our convening power. And the final thing is really credit to the IDF's leadership, that we have a commitment of IDF members already to invest and deploy capital into this strategy. As Bill mentioned, we've spent a year working with IDF members to develop this strategy, and to be able to go to market with a strategy that, you know, a dozen insurance companies have all said, this is how we want to invest in emerging markets, and this is the channel we want to create, is enormously powerful for achieving the scale that we want to. So I'll wrap up here with just how you can help. I want to say thank you. We've got a number of our insurance company partners who are in the room today who have already made commitments to this strategy, who have signed up to be partners with us. Thank you for your leadership. Thank you for trusting us to be your partner in this effort. And we want to invite anyone else who's interested on the insurance side, and we want to challenge governments and work with our MDB partners to find ways to partner to provide the catalytic capital that's really going to make this strategy a success. So please reach out to me if you're interested. We welcome sourcing partnerships as well. We're going to need to develop a very robust pipeline of the kinds of projects that will be eligible for this fund. And we're looking for asset level co-investors, of course, as well. And then I think, and we'll get to this on the panel here, credit enhancement tools that we'll need at the asset level, things like risk guarantees, FX swap facilities, the kinds of things that our partners are developing. And that brings me to my final point, which is we are at a unique moment in the market right now. We've got an increasing focus on the role that blended finance can play to catalyze finance into emerging market infrastructure. Plus, we have a growing acknowledgement that there's a huge market opportunity and that private investment is what is going to fill this investment gap. So I think now is the right time for this level of ambition, and we are extremely excited to be partnering with the IDF to bring this to fruition.
Matt, thanks for that. You can sense the excitement and the potential that exists here. I want to introduce our panel, because now we're going to get a reality check or some additional thoughts for all of us here. But we have a great panel from different perspectives coming down the line. Pak Rio, who is with the Ministry of Finance in Indonesia. You'll see further details in the program. Sarah Cardelli, who's a senior investment officer at Convex Insurance Company and helped on the task force. And Ethiopia, Tafara, who many of you will know, big involvement in the IDF for many, many years, but obviously great subject matter expertise. And I think, just coming back up the line then, beginning with Ethiopia's, you've heard and know some details about what the IDF wants to do, the willingness of the insurance industry to deploy capital, but the need for support in getting the right to deal flow, getting the right credit quality for these projects. So what can the World Bank, with all of its economic might, with its new structure, its new vision of doing things new and better to drive private capital into these areas, what do you think the World Bank, MIGA, but more broadly the bank can do to help support this initiative?
So thank you, Bill. I think Baroness Shriti set me up very nicely this morning for what I'm going to say we're doing at the World Bank Group, and in particular at MIGA. Many of you have heard that we're going through an evolution at the World Bank Group, very much based on a number of objectives. One of them being addressing collective action problems and addressing global challenges that can't be tackled on a country-by-country basis, although that is the manner in which we engage. We have country clients and we try to solve problems at the country level, but there are a number of challenges out there that are really collective and cut across borders. So we're trying to organize ourselves to tackle those challenges while remaining true to our mandate to support country clients. But the other objective of the evolution is to figure out how we mobilize more and more private capital into development and into development projects. So as part of that undertaking, we've engaged with a number of different parties, and the private sector lab being one of the important ones. And coming out of those discussions, what we've decided to do is basically create one storefront for all of our guarantees, whether they're bank guarantees, IFC guarantees, MIGA guarantees. You'll know that the World Bank Group is comprised of 3 or 4 different institutions. And each of us was issuing guarantees. And for clients, for the private sector, it was very difficult to know where to go for which guarantee. So we've decided, and the President has pushed us to actually create one platform for all guarantees so that clients know where to go, to have a conversation about guarantees that might be useful to them as they're considering investments on a cross-border basis. As part of that effort, we're also trying to be sure that the process of execution and due diligence is pretty much uniform, irrespective of the kind of guarantee, right? Wasn't always the case, right? Depending on which guarantee you're getting, the process for due diligence and execution wasn't necessarily the same, which was somewhat irritating to clients. And we're trying to get to a simplified process, uniform across all three sets of guarantees. And then, you know, how we book it, where we book it, that would be an internal matter. And we have 3 different balance sheets on which we would be booking these guarantees. So we're hoping from a client experience standpoint, this is an improvement and makes it easier for you to engage with the World Bank Group when you're looking to layer or blend finance, as Matt was saying. From our standpoint, the benefit that we see is that it's going to make it easier to bring different types of guarantees together in the same project, right? And there are times where a bank guarantee and a MEGA guarantee might actually be complementary. By way of example, frequently in energy projects, one of the difficulties you run into is arrears at the level of the utility, making it very difficult to service the debt. And we've provided guarantees in many of these projects and find ourselves engaging with the government based on a concern about pre-claims and eventually a claim to make sure that payment is made by the utility. What we can now do is actually use a bank guarantee. They have a liquidity guarantee that will allow, in times of difficulty in terms of payment from the utility, for that debt to continue to be serviced, right? And that makes that project much more viable and one that I think more and more investors would be interested in investing in. So that's what we're doing, Bill, to try and assist with the interest there is in investing more in developing markets, in particular in infrastructure, and expect that by virtue of putting all of this under one platform, as you heard this morning, we'll get to an issue. We're going to have a record year this year. We're going to issue about $8 billion in guarantees. By virtue of bringing this all together, we hope by 2030 we'll be doing $20 billion in guarantees, which means that much more investment into development and into developing markets.
Thank you for that. That is impressive, and I know that the work in the private sector lab has been, as Baroness Shriti said, you know, really concrete action focus, not just talking about what could happen, but this whole orientation is really encouraging. I think we all know, however, that there's no low-hanging fruit here. So it's going to be a challenge for everybody, but obviously joining forces is the way to do this. Sarah, let's turn to you, because Convex was in the mix of all of this. Be interested just to your reaction of kind of where we are, how this might, you know, fit within the Convex vision of how it wants to make its investments and deploy its assets, but interested in your just kind of inside view of all of this.
Yeah. Good morning, everybody. Yes, I'm representing Convex today, an international specialty insurer. I'm part of the investment team, and as asset owners, we are conscious and committed to allocate a portion of our investments to responsible strategy and sustainable strategy. So when Bill approached last year through the IDF task force about the opportunity to set up an infrastructure fund focused on emerging and developing market and to support the resilience of a vulnerable community living in these economies, we were very excited because it really aligns with our commitment to invest in those kind of more sustainable impact and investment strategies. From our point of view, I think the attractiveness of this proposal is based on 3 elements. First is a first attempt to do something driven by just insurance sector leadership. This is really a collaborative effort. There are many insurance companies involved. There is the IDF, there is the expertise that BlackRock brings into it. And I think that could be a catalyst for more to happen. It could be a catalyst to really mobilize capital, insurance capital, to support infrastructure and to make it more resilient to climate change and to natural disasters. So that's one of the main attractions. The other one is, I think and I hope, this is not just the first, but there will be more to come. So the scalability, the replicability of this model is what really attracted us to participate to these initiatives. It's just the first attempt, and hopefully there will be more money that will be mobilized towards this sector. And the third and important element is definitely the partnership with BlackRock. You need someone who is an expert. You need someone who knows how the infrastructure project financing works. You need someone that came up with ideas around innovative financing solutions like blended finance. And having this partnership with BlackRock make us feel, I would feel more comfortable. So these, I would say, are the three elements that really drive us to participate to these initiatives.
Very good and useful. Listen, to just do a little ad hoc expansion of our panel. I think Nitesh Mistry is in the audience, is he? I don't see he was going from Swiss Re. He was, I thought was going to be here, but is not. But if he arrives, he may give some similar views or give his views from Sarah. But then turning Pablo to you. You've got a huge job in Indonesia, responsible for all the state assets, which includes obviously infrastructure. You talked yesterday about the tremendous infrastructure development that's going on in Indonesia. Would be interested in your views of the financing for those projects. Most particularly, do you look to the private capital? Would you like to see private capital come in to co-invest on these projects? But what's your view on the ground in a country that has big infrastructure aspirations?
Thanks, Bill, and thanks for inviting me on this event. I think I really would like to speak straight and very frank with regard to this. I've been doing a transaction in '94. We did the IPO of our Indonesian biggest telecommunications. So since 24 years ago, I do understand that any investment would like to have a return. Right? And having met in here, we understand that actually BlackRock is also having a minimum rate of return. So I guess at the end of the day, the question is whether the country where this insurance money would like to invest in would give a better return to the money itself. I think that's the reality, right? So for Indonesia, I think, we do fortunate enough because our finance minister was the managing director of the World Bank. So she could translate what is it that needed by the market or by the world on Indonesia. Now, Indonesia now is in the interesting period because the elected president is already there. The handover will be in October. And we've been doing in the last 10 years, doing a lot of infrastructure investment. Now Indonesia is the economy of 1.5 trillion US dollar. It's growing. And because of our investment in infrastructure, we could keep our growth around 5%, which is not an easy task to do. Now, I guess for an investor to come to a country, the investor need to have someone that understands the domestic language of the investment, right? One of it is actually could be provided by the World Bank. World Bank could become the honest broker, or World Bank could also provide some of the tools where it would ensure the confidence of the investors. But on the other side, you could also see whether the country itself has put skin in the game. Like in Indonesia, now we set up what we call the Sovereign Wealth Fund, where we work together with other sovereign wealth fund, invest in Indonesian infrastructure. So I guess that's something that a country need to have, because it will not be easy for the credit committee of the BlackRock or probably the insurance to go into a country if it's not safe enough for themselves. And the other thing is, I guess, because you're talking about this PPP, Indonesia is also provided what we call, this is something that we learned from the World Bank, what we call as Project Development Fund. So we provide about $100 million at the moment for any PPP that need to have a proposal or a consultant to look at, and the government fund it. And then at the end of the day, it's up to the investor whether they would like to take that project or not. Now, on the insurance investment itself, in a developing country, we understand that mostly our financing coming from the banking side. So I guess probably this is one that the insurance need to look at. If we could replace that short-term financing from bank to the long-term financing coming from the insurance sector. And I guess that also would make a difference. Instead of going to the greenfield investment, you could come into a brownfield investment. The last thing that I would like to highlight also, not all of the infrastructure investment is good for foreign money. One of the questions that I have is, one of the multilateral bank came to me saying that they would like to give a loan for the toll project. And I said no to that, because the component of the toll project mostly is local, and then the income is also in rupiah. So why should we, well, if I could be frank on that, why should I accept that loan in US dollar? Because at the end of the day, it doesn't match to the profile of the investment. So that would be some of the thoughts that I have. Thanks, Bill.
Very useful in sort of the reality on the ground that is going to face this project, but faces all investors in this area. Let me just add a little more color on kind of where you were hoping to go with this investment thesis. It is a debt fund, as you would have gathered, so we're investing in infrastructure debt, not equity. But maybe uniquely, but very much aligned with the IDF mission, we're looking to invest in really small to mid-cap infrastructure projects, not the multi-billion-dollar ones. The reason for that is we want, again, consistent with the IDF mission, to enhance the resilience of communities to natural disasters. And we want to do that as quickly as possible. Our hope in looking at smaller projects, that they are, because of their nature, easier to get launched, built, completed, and begin to have an impact on lives sooner rather than later. It is also going to hopefully then provide the returns, and again, important to note, this fund is seeking and needs to obtain market rates of return on this capital. There's no way that we can scale up the amount of money from the private sector to meet the infrastructure demands if that invested capital doesn't make market rate returns. So we want to do this, we want to launch this, to deploy the assets quickly, see the results relatively quickly, and then be able to scale it up, because we'll have proved our thesis that it does work, and then I think the floodgates could really open up in this area. But it's going to take partners. It's going to take partners on the ground, both with the government specifically, the World Bank, very important, but also, as everyone knows, UNDP is a major part of the IDF. They've been around this. They can be hugely helpful on the ground, finding projects, just managing all of the relationships and all the elements that deal with working. And again, I guess it's been implicit, we should make it explicit. We're only focusing on emerging developing economies. As has been noted, huge infrastructure needs in the UK, in the United States, throughout the developed world. But again, consistent with the IDF, this is focused on emerging and developing economies. Matt, give you some thoughts and either reactions to the panelists or questions, follow-up questions for the panelists.
Sure. I think the comments from the panelists give a sense of the landscape of challenges that we face in actually both creating a strategy like this and then executing it, but it also reinforces the importance of stakeholder engagement. And I think, you know, we hosted a roundtable last week on blended finance specifically, and we realized, you know, there were 25 participants at the table, just like there's 5 people on the panel here, and everyone has a critical role to play. And so I guess, you know, my challenge to this audience is to understand, you know, what is each person's role to play and what's each organization's role to play. And, you know, I think what we are creating here is a commitment on the part of the IDF, certainly of BlackRock as one of the leading global asset managers, of stepping forward and saying, we're going to convene, we're going to create this table to sit around and have this conversation and find some of these solutions. Ethiopius, we're going to take you up on your offer to be the single point of helping us understand how to navigate the myriad of credit enhancement tools that are available in the market. And hopefully this will be a test case for all of the different seeds that are being planted in this market today to see if we can really produce something at scale. So, you know, thank you for your commitment, everyone at this table, and hopefully we will inspire the countries we're investing in to develop the projects that will create the pipeline for this strategy.
Yep, great. Ethiopius.
So I promised I was going to pose a challenge to you, right?
Yeah.
And so I'm going to do that now. In light of the comment you made at the outset about the lack of bankable projects or the shortage of bankable projects. Because I think the risk that we run is we're going to all be scrambling over the same projects, right? And I see that already in the multilateral world. You see that big with commercial banking, right? So I think we need to think about how we can join forces to help with project preparation, right? So that we have more bankable projects in which we can actually invest all this money that we want to invest. Over the course of the past couple of years, I've been doing a series of roundtables regional roundtables in emerging markets, bringing together ministers of finance on the one hand, our clients on the other, with us sitting in between to be the honest brokers, as Rio suggested. They will come with 15, 20 projects they'd like to see invested or invested in with using private capital. And our clients on the other side of the table will say, that's fantastic, only 2 of those are bankable, right?
Yeah.
The reaction from the ministers of finance is not despair. They're like, well, help us get it to bankability, right? What can be done to get this to bankability? Because we really would like for them to be bankable. It's not unwillingness. It's just not, you know, it's a capacity issue at some level. And so we can be the honest broker, but the expertise as to what's going to make that project bankable for you is something that somehow we got to find a partnership. Otherwise, we're going to be chasing the same projects, more and more money chasing the same projects. So a plea for collaboration on project preparation.
Very relevant and valid points that you make. I will say that the Infrastructure Task Force of the IDF has had 2 work streams. One was on investing on the asset side, and this is what we're really talking about today. We did have another, it's still alive, it's modestly dormant, but it's going to come back to life on Tuesday of next week or sooner, which is on the insurability of these projects, because in discussions, particularly with our friends at Asia Development Bank, again, another member of the IDF, it came to our attention that they have a lot of small projects, the ones that we're interested in, that have funding, have permitting, and late in the process then say, geez, I guess we need insurance for this project. And can't get the insurance for a whole lot of reasons, but a lot of it echoes exactly what you said. They weren't thinking about what it takes to create an insurable infrastructure project day one. It's at the end of it. And then, because we pulled together a group of underwriters, brokers, all expert in this area, and in looking at this, they said, this is the problem. They come and they're not insurable. And what you've just said is, yes, they're put together in a way, and that makes them not bankable. But we have to, this goes back to the the fundamental conundrum. There's this huge need and this huge willingness, and we gotta we got to make those pieces fit together. I think BlackRock, it is perfectly positioned to help because you deal with so many asset owners. You know what they need, what you need, and I think it seems simple, and I also think it could be done, pretty quickly. What does this look like? What does A look like? What does a B level project look like? And then start with that day one. We've got just a bit of time. A lot of people in this room know this topic, have thoughts on this topic. If anybody has any observations about how to make this successful or what you see as the biggest challenges for us, be happy to take your question or your comment now. Ken.
Previously, rolling down and talked about could securitize for gas products in order to given this work in a way that potentially these projects could be vulnerable.
Yeah, that's definitely, to be clear, what we're talking about investing in here are private direct investments in emerging market infrastructure projects, different from sort of the wholesale securitization of MDB loans, which is another nascent market, as the Baroness talked about this morning, and one that we're very interested in and want to see the development of. And certainly this idea of creating a new asset class of development finance assets, I think, is exciting to all of us who have worked in this space for some amount of time. So certainly the projects that we invest in, we don't necessarily hold for the life of the investment. There's certainly a secondary market for these. There's refinancing that occurs on a regular basis. And we are hoping that by deploying capital into this market, we are increasing the commerciality of these investments, and we're creating opportunities to catalyze additional finance on these existing projects as well as new projects in the future.
Yeah, I think it notes in the effort to really have an impact in communities through this IDF vision on this. We want to invest directly into these projects. You're right; those projects could be bundled and perhaps securitized. Something to think about. But our goal at this stage is indeed these direct investments. Do you have a reaction to
I was going to say, bank projects historically have been quite bespoke, understandably so, and I think, in some measure, that will continue to be the case. However, there's a group sitting down to think about, are there certain types of projects that are originated by the bank that can be structured in such a way that we securitize them, 5, 10 years in, right? So, and looking at documentation and looking at how we can get consistency in these projects so that they are able to be securitized. So there's active ongoing work on documentation, on how they originated, the role that we can play, for example, in credit enhancing once it's refinanced by commercial lenders or others. So yes, but that's going to take a little bit of time. And I think for a lot of bank projects, they'll continue to be bespoke given the nature of these projects. But we're trying to figure out a way to actually make them more securitizable, if you will.
We have time for one more question in the back. Thomas Kessler from Asia Development Bank is here. Thomas, you wanted to say something.
Thank you. Comments on project preparations, and there's a multilateral initiative which is called SOURCE, which is a digital platform to help governments with a project, and I think we should leverage this big time and include risk management aspects in the project preparation. Another thought and a question that we yesterday we had Jonathan from AIS, and what's the role and how do you integrate the regulator and the supervisor in order to facilitate maybe more easily for insurers to time in terms of investing into infrastructure?
I'll respond on the regulatory side. When we began the insurance task force a few years ago, even before this initiative, the first thing we did was begin to look at the regulatory, particularly the solvency capital charges, which are applicable to these investments, at least under Solvency II, US RBC, and the other major areas. We just had a conversation with other of your colleagues in the bank last week on this subject, where it came up. There are legal restrictions, just prohibitions in a number of countries of having insurers invest in infrastructure, or there's obviously if it's cross-border investments, there's there are restrictions there. The International Association of Insurance Supervisors is here. I think Connor Donaldson may still be here. We're in active dialogue with them on many topics around the insurance industry and closing protection gaps, as some heard yesterday. But we've also raised with them that we'll probably want to revisit this issue of where are there actual, even if we had a great series of bankable deals, we're dead if the local laws say that this fund can't invest in that, although this will be a fund investing, not insurers investing, directly. But it's a topic. I will say, and Thomas, your support and interest in all this has been longstanding and has been great, and clearly the regional there's a whole society of DFIs. We need all hands on deck. And we're going to want to have conversations with people, particularly who have regional expertise. That's going to be so important. Going back to your comment about, every country is going to be different, and you've got to know your way around. We're 2 minutes over, Equishway, but we're more or less on we're on French time, not Swiss time, but it's okay. Thanks to everybody. Thanks to the panelists for their comments.
Bill, for that, and really excellent conversations. And it really nicely segues into the next panel, which is focused on financial protection of public assets. And there's a little bit of history here. I remember when I first joined the IDF in 2018, the World Bank raised this request on the basis that they were having these conversations with governments around insuring public assets, and they approached the IDF to really explore the development of a guide to ensuring public assets that they could use in the engagement that they were having with governments. And we developed this guide, and it's really remarkable to see the way it's being used in various countries. And the fact that we can have this conversation here today on this topic is also quite important. And again, building on some of the comments from the last panel. So with that, I would like to invite Olivier Mahoul, who is the practice manager, Crisis and Disaster Risk Finance, within the World Bank Group. And I will also just say, acknowledging yesterday, the convening that we had, as was said earlier, with the government officials was really facilitated by Olivier and team. So really thank you for that, Olivier, and let's get into a very interesting conversation.
Thanks, Equishway, for the kind words of introduction. So I will try to stick with what Ivo asked us to do at the very beginning, to focus on facts, be sharp, be short, and go to the substance. Nevertheless, let me again acknowledge the fantastic partnership with the IDF, including, as Equishway mentioned, on this topic of insurance of public assets and financial protection of public assets. Just a kind of key numbers to set the scene, if I may say. So, on average, every year, the overall economic direct and indirect impact of public infrastructure disruptions is estimated between 400 billion and 650 billion. A lot of money, not only on direct impact, but also on indirect impact. And when we do at the bank what we call post-disaster damage assessment following a disaster, and when we look at the impact, the impact on infrastructure, on public infrastructure particularly, can be 20 to 30% of the total losses. So this is a major source of contingent liabilities for governments. But also beyond that, it's a major source of liability in terms of livelihood. Because if your public assets cannot be quickly restored, roads, access to water, access to electricity, the one who are going to, I would say, be the most affected will be the poorest and the most vulnerable. So the economic disruption is as important as the asset itself. So in that context, we've been working in the World Bank on that topic for some time, together with the private sector. And let me maybe highlight 2 or 3 key lessons that we learned, and I'm sure that our speakers today will elaborate on that one. One, it's important to have a kind of very clear and strong regulatory framework in order to enable financial solutions. And we discussed that particularly in the context of of crowding in the private sector. Two, and this is something we discussed extensively yesterday, is about having access to sound risk data. I would not say more data, I would say better data to inform our decision makers and to turn technical data into financial data, which again will inform our decision makers, particularly in the public sector. And the last one, which is fundamental, and again we'll go back to that, is good risk management practice. In many countries, what we see, what we observe is sometimes simply the lack of maintenance, the basic maintenance of the assets. So it's very difficult, of course, to plan for extreme events and to be able to recover from extreme events if your daily, I would say, or small disasters, not even disasters, the daily maintenance is not properly maintained. And we know that some countries are facing some challenges. So they had just initial thoughts, but now let me introduce our distinguished panelists. Let me start on my left with Elizabeth Toledo. She's Director of the Fiscal Risks Directorate of the General Directorate of the Public Treasury in Peru. We have Joselito Basilio. He's a Principal Economist in the Department of Budget and Management in the Philippines. And then we have two private sector colleagues joining us. Claudia Tim is the Director of Strategic Market Development at AXA XL, and in fact she's one of the co-authors and the lead author, in fact, of the IDF Practical Guide to Insuring Public Assets, and she's also the co-chair of the IDF Sovereign and Humanitarian Solutions Working Group in the IDF. And last but not least, Panayotis Koulovasilopoulos. I practiced. He's senior underwriter of ICOX, one of the Lloyd's syndicates. He's also the chairman of the Lloyd's Disaster Risk Facility and also a member of the IDF Sovereign and Humanitarian Solutions Working Group. So let me maybe start with our, I would say, public sector colleagues, if I may say. So maybe, Elizabeth, one question. The government of Peru has identified in the 2014-21 National Disaster Risk Management Plan as a priority the development and improvement of disaster risk insurance programs, particularly for public assets and for concessions. So can you tell us more about what has been done and what are your lessons learned you could share today with us?
Hi. Yes. Okay. Good morning, everybody. Yes, as you said, we define as a priority to strengthen the insurance of the public assets. Unfortunately, we have some progress in some things, but we have too much problems in others. I'm going to start for the negative things that we are trying to correct them. Okay, we used to have a legal framework that has an obligation to the entities to insurance the public assets, but it said that they have to do it, but with considering the prioritization and the budgetary restrictions. So at the end, nobody insures the public assets. Few entities did it. Okay, I think that this framework didn't allow us to improve this objective. But at this moment, this framework has been derogated, and now we have created, the Ministry of Finance have created a General Directorate of Supply that is responsible of to promoting and strengthening all this insurance for the public assets, and they are responsible of giving some guidelines, and they are starting to do this job. They have at this moment they have issued already guidelines for the movable public assets. And in this case, it is obligatory to do that. They published it in 2020, and from 2023, they are forced to do that, the entity. So I think that it's a progress, because in this case, it's like the government is taking his role of lead this progress. No? This is in the case of the insurance of public entities. Besides that, they have a draft of the guidelines for the unmovable public assets too. So they are going to reviewing it. On the other hand, I think that we have made some progress, or a lot of progress, I mean, in the case of concessions. Because since 2019, we published guidelines for the design of PPP contracts. In this framework, although it was just suggested that include some clauses in the contracts in order to have insurance in the PPPs, although that they are considered in all the contracts. So it was like a suggestion, but at the end it's like an obligation. So the office that is in charge of these contracts, they consider it, and there is the regulator, depending of the sector, who is in charge to the regulator or the concedent, or they are the one that has to follow the compliance of these things. At February of this year, we have $22.8 billion of insurance in PPP contracts. So I think that it is something that is very, very important for the government, but because it's going to reduce, in the case of natural disaster, the impact, the fiscal impact. These contracts are related to the insurance under construction and insurance in operation, both of them. And well, besides that, I think that I mentioned this because it's an experience of as a government that we, within the framework of the Pacific Alliance, with the 4 countries of the member, the Chile, Mexico, Colombia and Peru, through the issue of the World Bank, we were allocated with 200 million, and in an instrument for 3 years. And well, we have at that moment we got it in 2018, and in 2019 there was an earthquake of 8 degrees in one place in the country, but it doesn't. The earthquake doesn't cause too much damage, so we have a positive basis risk, and we got 60 million from the insurance because we activate the coverage. I think that these are the things that I can comment about my country.
Thank you, Elizabeth, and I'm sure we can elaborate later. Let me now turn to Roselito, moving from Peru to the Philippines. So Roselito, the government of the Philippines has started the journey on disaster risk finance for long time ago, but more than a decade ago, and now has come up with a pretty comprehensive disaster risk finance strategy. And more recently, the Philippines launched a specific insurance program for public assets to complement this strategy. So can you tell us more about how you ended up with this program and how this program of insurance of public assets fits in your broader disaster risk finance strategy in the Philippines?
Right. Thank you for the question, Olivier. And good morning, everyone. So yes, the Philippines has this disaster risk finance and insurance strategy since 2015, and now it's 2024. And it defines several priorities, which are the following: maintaining sound fiscal health for the national government, and developing sustainable financing mechanisms for subnational or local government units, and then reduce the impact on the poorest and the most vulnerable. So much so that public asset reconstruction oftentimes comprises the largest percentage of the national government spending after disasters. And the World Bank and the Philippine government conducted a public expenditure review on post-disaster spending and found that on average, the government spends 4% of annual budget only for response and reconstruction after disasters. ADB has another study, they said it's 6%. So this is not sustainable, especially if the superlatives continue. So we needed to find or top alternative financing mechanisms precisely to identify public assets that are appropriately insurable. But this took a long time on our part. We know that data is not freely available. There's no such thing as free data. And so we tried to have a mechanism, even in Excel files or Excel matrices, to have a sort of initial database of national asset registry system. We trained national government agencies so that they will have knowledge of how to profile public assets and the risks going forward. So we have expanded. So under the DRFI, or financial strategy, we have come a long way. The so-called indemnity insurance program has complemented the catastrophe bond, parametric insurance program, and other several initiatives, including crop insurance to protect farmers and households, as well as local governments. So currently, we're improving on our risk information systems and the related analytics. So to address the prioritization in the indemnity insurance program, we are now trying to establish a digitalized public asset repository, which we call National Asset Registry System, and this follows the creation of Philippine government asset management policy and consistent with a national asset management program. In the first year of implementation of the indemnity insurance, it covered 132,862 public school buildings. We budget around $36 million, but the challenge is we cannot use all of this, unfortunately, because of data problems, access by different schools, and etc. And of course, issues with the insurer, which may or not be capable of insuring all of these assets. So we were only able to use $14 million out of the $36 million budgeted for this. So overall, the aim of the financing strategy of the government is to transfer risk from government while benefiting from the cost efficiency by transferring a portfolio of risk rather than single asset placement. So we are already in the process of improving the program by having a medium-term insurance plan aiming to scale up and improve the program. I will end there, and thank you.
Thank you, Rosalito. On one point I'd like to highlight, and maybe our private sector colleague can reflect on that one, the efforts the Philippines are doing to set up a national database for public assets, which hopefully can be also helpful for you. So, Claudia, on that point, so we heard from the Philippines, we heard from Peru. You've been, as I said, the co-author of the IDF Practical Guide on Insurance of Public Assets. So in your opinion, what will be, since we should not use should, so what will be the next 3 top priorities you would see the insurance sector and your company also could take in order to facilitate or to support the development of insurance programs or protection of public assets in the middle and low-income countries?
Yes, thank you, Oliver, for that question. first, before getting into those three priorities, let me highlight, and I think you hinted at that at the beginning, that I think this is an effort, it needs to be a concerted effort, right, by industry, but also by regulators and supervisors, multilateral organizations, and the government themselves. We know that it can be a little bit of a daunting task for some countries to engage in these efforts. So what can industry do? And what are we doing already, actually? First, not only advocate for the use of insurance protection for public assets and the importance, I think many countries are aware, but actually provide education and ultimately share our experience, our expertise, and facilitate that. What you mentioned, I think this guide, practical guide, we called it, to ensuring public assets by the IDF, was such an effort, really. It really walks governments that want to engage in this journey through every aspect that needs to be considered ahead of engaging in this effort. In fact, the Knowledge Day that we had together yesterday is also such an example, not only because of the exchange that we had between industry and the countries, but the ability, the chance for this peer-to-peer learning that Ruth was referring to, and other countries hearing from your experience, Joselito, in the Philippines. I think that's very important. We are also, for example, in the context of the tripartite program, encouraging countries to ensure the public assets and bring our knowledge in there. Second, the issue of data that you raised, I think it's a very important one, and we did a very short survey of the officials that were coming to yesterday's Knowledge Day ahead of them coming, and both the biggest challenge, but the biggest priority that they highlighted by far compared to the others was the challenge of data and risk understanding. And so we know that that is a concern and something that sometimes stops or delays the start of such efforts in countries. And so sharing how whatever local data is available can be complemented by the use of technology, I think is very important. It's something that we bring into our projects. Not only things like satellite imagery, but the use of intelligence photography that can not only document, but also verify buildings' characteristics, for example. For vast facilities, the use of the same cameras and sensors that self-driving cars use for, things like railways. So there are things that we can bring in to help countries complement what they have. Also, sharing in terms of what type of data is needed, and we help countries with this. Finally, I think encouraging this collaboration across sectors and across different actors. As I said, regulators and supervisors, but also public-private collaborations, such as the Global Risk Modeling Alliance, right, that actually looks to bring this data and risk analysis expertise into countries is very key. So I think there's a lot that can be done, but that we are already doing very much a lot also through IDF and in collaboration with many, many organizations that are here today. So.
Thanks, and I'll go back to you with a slightly more provocative question later. Panos, again, and maybe using your experience as a chair of the disaster risk facility, how would you approach this market, and what kind of, I would say, partnership, public-private partnership and structures you would think are more suitable for this kind of insurance of public assets? I mean, what would be your recommendations to Joselito or Elizabeth if they were, if they want to improve even further their program of insurance of public assets?
Yeah, sure. Thank you. Well, the topic of public assets is such a massive one. There's such a big difference between protecting schools and hospitals, protecting network assets such as sanitation, your electric grid, water, or government buildings, which are more independent, require more attritional. There are a variety of different products, but before we get into the products, insurance critically is a complementary tool as a part of a wider resilience strategy. So when we're thinking about public-private partnerships, when we're thinking about what products are available and we can use, we have to think about it in the context of what is the problem, what is the overall resilience and financial kind of strategy to budget and to improve the quality of lives for your respective populations. In terms of the types of products, you've probably heard a lot about parametric insurance, and actually the catastrophe bonds are based on the parametric structure. And from Joselito, you heard an indemnity structure, which is paying out on the actual loss damage. There are advantages and disadvantages to both, but crucially, it is asset specific, it's country specific. Even within a different country, you're in a north part of the country versus south part of the country, a coastal destination versus an urban destination may require different needs. Now, parametric insurance, obviously, we all know, has the benefit of a fast payout, and so it can be complementary to an indemnity product. And it's important, these do not have to be binary. It's not one or the other. A parametric insurance policy can provide help with disruption of services. So following a disaster, getting temporary schools, temporary hospitals up and running costs money. It requires budget reallocation, which may or may not be possible. So it's trade-offs. So when we're thinking about assets which require immediate influx of capacity, a parametric structure may be something that we used. But ultimately, these assets for larger disasters may require reconstruction, and an indemnity product may be appropriate. However, an indemnity product is not that easy to set up. It requires a lot of information about the assets, because the cost of rebuild, as Olivier pointed out at the start, on a damaged asset versus a brand new building might not be the same, and capturing that nuance changes every year. There's a lot of maintenance required to maintain that quality of data. So there are normally halfway measures. There could be a quick payout, which should cover 80–90%, and then perhaps a top-up cover. When we're talking about public-private partnerships, it's not just the insurance industry and the governments, it's the whole ecosystem. It is the multilateral development organizations, it's the banks, the lenders, it is the people on the ground, the first responders. It's having the financing match up to the full protection of that ecosystem. And the importance is, it's a unique problem that requires everyone to get in early, and it takes time to set up.
So before I go back to Joselito and Elizabeth, let me now ask my slightly provocative question. So Joselito mentioned that developing a database of public assets takes a lot of time and costs a lot of money. And of course, there are multiple applications, including insurance. One question we've got in multiple occasions when we talk about developing such database with of finance is, what the benefit for me? So practically, if I do this effort to collect public data on my assets, how much premium reduction I can expect versus if I don't have this kind of detailed information? So could you help us qualify, or if ideally quantify, to some extent, the benefits of making efforts from the government perspective to collect those data, acknowledging that there are many other applications, but what would be the direct impact on the cost of insurance if a country is able to provide you the right level of information? You want to start, Claudia?
Should I start? I will not put a number on that, but I think that what we can say is that when there is an aspect of black box, when there is uncertainty as to what we are looking to insure, naturally the price is going to be higher because it's considered to be potentially a bigger risk. So the more we know, and the more you know about your assets, by the way, the more the country knows, the better and more appropriate the solution is going to be, and it's going to be better priced. Because I think that's the beauty or the interesting thing for countries, that data is not only about enabling the use of insurance, but also prioritizing, right, in the country, which type of public assets, as Panay was saying, there's so many different ones, which ones do you prioritize, because not everything can be done at the same time. So, but coming back to pricing, yes, it affects pricing. The more data is there, the better.
Panos, can you be more quantitative here?
Can I be more quantitative? Well, again, show me the numbers and I can give you a price. But it's not just about the numbers, actually, because it's about a strong governance structure, as you said, because pricing is one thing. However, when public asset schemes get put together, we're paying out to who is the policyholder, how's the loss adjustment made, can we send people out to validate the claims and not. So there has to be a very robust system which is which can't be interrupted, can't be corrupted. It's very robust. So it's not just about the pricing. And when we have these uncertainties, sometimes risks become uninsurable. So the question is not just about can we reduce the price, is can we even insure this? There are certain principles of insurance, pooling of risk, moral hazard, low chance of being hit, and several others. We need to make sure these are ticked, and that's important before we even get to the pricing. When it comes to pricing of risk, as Claudia said, we have the physical hazard. We're trying to understand the climate and the seismic risk associated with it. Then we go to the vulnerability of the assets. But at every stage, we make assumptions. And when the data is old, the more assumption gets old. When the data is incomplete, more assumptions are made. So the more assumptions have to make, the more uncertainty it is. And as insurers, we tend to lean on the side of caution. So there is always an implicit load, in my view, in incomplete data or not the same high quality of data. So you will get charged compoundly more, in my view, for not having that kind of complete data. But each to their own. There might be a variety of insurers out there.
Wonderful. Thanks, Pani and Claudia. So, Elisabeth Rodriguez, you heard about our colleagues from the private sector. If you were to make one specific ask to Pani or to Claudia on this is what I need from you to help me better either convince my minister or to set up a proper program for insurance of public asset, what will be that specific ask? Elisabeth, do you want to give a try?
I have a lot of things.
Okay, please, at least one, but more. Yeah.
But only what I say, when I think about it is like, how can I ask if we have still to do our job? I think that we have to start as a government to do our job, to have data, to reinforce our capabilities, to engage with this matter of disaster, natural disaster, no? Engage to improve our level of coordination. So first we have to work first, and then we have to ask you. And besides, in this case, perhaps just quickly, you have to try to understand us. Perhaps our interests are different. We ask you innovate mechanisms in order to help us to reduce our risks. Perhaps you can help us to, as yesterday I said, to reduce the lack of awareness, not only in the population, but also in our public entities too. Perhaps trying to be near of us, trying to help us to identify the risks, to give us alternatives, to reduce some costs, because costs are most of the time the barriers, perhaps, that are avoiding that we consider in a more proactive way the insurance. And perhaps the last one is that to share, if it's possible, your information, the information that you can have, because if we are not we don't understand exactly what this is, we are not going to be able to talk to you, no, to be in the same level. So I think that's a long way, but we have to start by ourselves.
Okay.
That's all. Thank you.
Thanks, Elisabeth. Joselito, same question to you.
Maybe. Yeah, I have several, but the plea is for the private sector to continue innovations and blending of the different fit-for-purpose types of financing. So different kinds of contract may fit different types of assets. So right now, for example, agencies have already filed up to 300,000 types of assets, including hospitals, irrigation facilities, and some power assets. So developing and offering new risk transfer mechanisms that address gaps will be really helpful, including, of course, ways not only the actual insurance activity, but the prerequisites to it, which were discussed extensively, which is gathering of quality data. Of course, there are specific issues that we'd like to improve on. For example, access to parametric insurance, which had not been very easy for our subnational governments, because probably the guidelines is too restrictive that they cannot access it right away, which defeats the purpose of parametric insurance. Of course, private sector partnership, especially on large infra projects. So at the project level, maybe there could be a single insurance mechanism that reduces, for example, contingent liabilities of the government. So there are many areas to collaborate further and seek private sector suggestions on ways to improve risk and disaster financing in the country.
Thank you, Roselito. So Claudia and Pani, more or less the same question. So from your perspective, when you engage with the clients, and of course we'll agree that, you know, the level of understanding of the clients may differ, of course, among countries, but what will be your kind of first ask to have a kind of constructive discussion that will lead to some specific solutions? So what is for you the main ask you would make to the government?
So I would express it in three parts, if I may.
Please.
But I think if we think about it, ultimately, the journey to ensure public assets is a long-term commitment that requires things like policy, right, and the right regulation, ultimately to drive resilience. And I'd like to pick up on something that Jonathan Dixon said yesterday, which is companies, our large corporate clients, have chief risk officers. Why don't countries have chief risk officers? And in my view, ultimately, that should be the role of the ministries of finance. Because in conversation with some of you country officials during yesterday, we were hearing exactly about that challenge that they are different, either ministries or agencies within government that do different things, and there's too many barriers. And the Ministry of Finance taking on that role of also becoming almost like a center of excellence for insurance, I think would be really helpful. So I think that's one idea that I like from Jonathan. Second one, I think, is tap into the resources that are there. I think we've been hearing, and at IDF we always hear about it, but World Bank, Global Shield, Insure Resilience Solutions Fund, I think the importance of ensuring public assets, and also in the aspect of data, of helping there, it has been recognized and resources are there. And thirdly, engage with industry, right? We are not only about providing the product, but we can bring our expertise. And not only the global expertise, but we do collaborate in our projects, for example, with local actors, often universities, your own agencies. So it's very important to bring the global and the local aspects together. And I think that can happen through this engagement.
Thank you, Claudia. Pani.
I mean, Claudia's covered all the technical points. I'll keep mine more simple. I guess, where can we help? Tell us where the volatility is in your budgets, by type of public assets, is it your schools, your hospitals that you're worried about? Is it your the maintenance of your electricity grid? Is it your natural assets? Is it your coastlines and your mangroves? But we're here to help and we're here to listen. And our ask is, the more you can share, the more we can do. We're always happy to have a seat at the table early and engage early. And we might not always be, insurance might not always be the most appropriate solution, but it can cover a lot. The point of insurance is to de-risk, to provide certainty, and to take out volatility so you can plan more accurately. So we're here to help. Thank you.
Thank you, Pablo. So as I want to try to summarize again, maybe one point from my perspective, coming from the World Bank, and why we think that this topic is is a development issue. As I said in the introduction, it's not about the assets, although we talk a lot about assets, it's about the services provided by these assets. And as I said in the introduction, the economic impact in terms of dollars, but also livelihoods, that the disruption of critical assets can have on the poor people particularly is quite important. So this is very much a kind of development agenda as well, as much as it is a pure asset management agenda. On that note, thank you very much to our panelists. If you can join me to thank them very much for their insightful comment.
Okay, thank you very much, Olivia, and to all the speakers. I think it was a really great way to transition from the conversation that we started yesterday, which was a very high-level conversation, bridging the political with the supervisory views, but also with the industry views, to earlier today when we talked about some of the broader global policy developments happening, if it's with the reforms, et cetera, to very concrete things in terms of the challenges that governments have to contend with in terms of looking at this issue of insuring public assets. So I just want to use a few minutes. I think we would have heard a lot about, the various country representatives that are here with us, the very interesting, in-depth discussions that we had yesterday with the country delegates. And all of that falls under the umbrella of a partnership that the IDF has, I would say, in some ways formalized with the World Bank Group. As you all know, the World Bank Group is a co-chair of the IDF, along with the United Nations Development Program. With UNDP, we have quite a substantive program ongoing. But this program with the World Bank really comes from, again, the experience that the bank has in terms of engaging with clients, as well as the IDF and the capabilities that we have within the IDF to really think constructively about how do we address some of these issues around capability development. How do we form a longer-term, lasting partnership and portal for engagement where countries can engage with the industry to address very focused and specific questions? So over the last few years, there are a couple of things that we've done sort of informally between the IDF and the World Bank. I referenced earlier the fact that, we had published this report on insuring public assets, which has subsequently been used by quite a lot of countries. But there have also been moments where we've organized convenings in London or elsewhere, where we've brought the best of industry expertise to engage with country counterparts on very specific issues. I recall vividly in 2019, when there was a delegation from Morocco that visited us here in London, and we corralled a group of real experts to have very intense conversations around the Solidarity Fund at that point in time, right? And it wasn't just the underwriters, it was also the legal experts from the law firms, et cetera, to provide the views. Then I also recall, more recently, the convening that we had around Takaful insurance. That's an incredible opportunity when you think about that part of the world and how we engage them around financial protection. And that was, again, a focus on specific thematic issues that matter to countries and matter to communities and matter to people, and really trying to think through what kind of innovation is required that we need to drive, but we need to do it in partnership. And then the third element is also, the fact that we have people who are sitting within ministries of finance with tremendous capabilities, but tremendous challenges as well in terms of financing the plethora of issues that they have to deal with. But yet, this awareness to the fact that there is a need to better manage risk. There is a need to look at different financing instruments. There is a need to think carefully about the trade-offs associated with this. And that was really what spurred the thinking around the structuring of an executive program with the World Bank Group, where we would have senior representatives from these governments, from ministries of finance in particular, to really begin to build that community of practice. That's how I see it. So we really just wanted to use this opportunity to pause in the middle of the day to give you some insight into the nature and why we have emphasized so much within the convening today, the presence of the delegates from countries and the need for collaboration. It sits within that context. We have this partnership with the bank, we have the partnership with UNDP and many other institutions, but it's that collaborative effort that we want to cultivate as the IDF, because that is our job as a forum. It is a forum to really bring insurance capabilities to where it is needed and in the interest of those communities who right now are dealing with a lot. So again, I will just perhaps hand over to Olivia to offer your reflections on this. I think it is a great moment, a lot of work to be done, but I'm sure that you can sense the interest, the enthusiasm, genuinely to collaborate on this. And I'm really looking forward to working with you and the team in a much more deeper, practical way. So over to you, Olivia.
No, thank you. So I will be very brief. I think you said it all in a much nicer way than I could say. But just to highlight a couple of things, this is very much here talking about knowledge to action. And in fact, the timing is perfect. As you know, last April, our World Bank Group Presidents launched this Knowledge Compact, trying to revive, in fact, the role of the bank as a knowledge bank. So I think the partnership with the IDF is a perfect example of how we can bring partners, including the private sector, to some extent to help us increase our knowledge and then, of course, inform our clients for action in terms of policy actions as well as more specific products. So yesterday was definitely a kind of lightning moment for most of us, having more than 30 countries or 21 countries in the room, 30 participants exchanging on this very specific topic. And frankly, if I may say, you could see the journey most of the countries have gone. If we had to have this conversation a few years ago, I don't think we would have this kind of depth of conversation, but a lot of countries have learned, have practiced, have done a lot of things, and now they're also able to share experience with us, but also with the private sector. So as you said, Ecosway, tomorrow we're going to have a dedicated executive education program on climate and disaster risk finance together with the University of Oxford. I think next month the IDF and the World Bank are also organizing a study tour, bringing countries together in Asia, also to share, in fact, in that context of takaful insurance. And we look forward to doing more on that, either virtually or through events like this one, again, to share experience, and most likely also to bring our clients closer to the finance at the end of the day and to the insurance market. Thank you very much.
Okay, thank you, Olivia. And I will also just finally, on that note, acknowledge obviously the Vice President who was here earlier today with us, Pablo Saavedra, and also Hiroshi Matano, who's the Executive Vice President of MIGA, and also co-chair on the IDF Steering Committee, who have really been forces driving this development, so quite positive. With that, please feel free to, yes, catch up with colleagues, and eventually we'll get to the discussions. And I hope that you have enjoyed the session thus far. Thank you.